Hello, everyone, and welcome back to another quick update on a few things, surrounding StashAway and the markets in general. Today, we want to update everyone on one of the most talked about events probably of 2018, the Kim-Trump summit here actually in Singapore, so very relevant to people living here, and most of our customers will be affected by it probably, by traffic jams and things like that. Then we'll give a quick update about the G7 meeting this weekend happening in Canada. I think it's also very relevant to the markets right now, especially with the trade wars still going on. Last time we talked, we thought they would kind of be slowing down, or like we're getting to Trump was talking to China to actually smooth out the trade war. Now it seems they're all back on. He's opposing his allies in Europe as well and Canada. So let's see how that goes. And then we'll give you everyone here another market update in general, kind of what's going on in the market. So Freddy, with that, let's talk Trump-Kim summit in Singapore next week.
Where is it again?
Capella Hotel, yeah. They decided finally Capella Hotel. But
so minor traffic and personal safety. But other than that, going into this, it's good to step back and think about the context for the historic meeting. For North Korea, total denuclearization is something that is very difficult to stomach. The last time we almost canceled the summit because Bolton from the Trump administration actually talked about the Libya model. If you recall, in Libya at the time, Gaddafi actually did what they are doing now. Totally denuclearizes, but end up being overthrown in a subsequent internal warfare, and also with a foreign intervention, and he end up being a dead man. So that reference has actually spooked Kim so much that that's why they had this very bad rhetoric that led to the cancellation of the meeting. So, and now we have a massive U-turn, and they're gonna have to meet in neutral grounds now in Singapore. So the context of that is that Kim needs to feel safe for things to happen. The fact that we're able to meet here means that there's probably some better amount of trust that's going on.
But do you think, is there like some kind of like different scenarios of how they can actually play out with that? Because there's a lot of talk, like will they actually do it? What are they going to do? Is there anything going out of this, just PR?
But our expectation is that this is just the first of many meetings. That's going to lead to more trust building, more details being hammered out, that hopefully may be leading to a denuclearization timeline, which is why the US have also stepped back this time and said, we want a timeline that's going to be proposed by North Korea, but we're not going to demand an immediate total denuclearization right now. So that sounded much more reasonable, hence leading to the meeting. So it's pretty good scenario. Our expectation is the meeting will end up with a lot of romance moments that promises each other to meet again and to further iron out things. That's my base case scenario.
Yeah,
but there's also the risk.
Yes.
The risk is that they end up in another angry exchange, immature exchange, and the market in the short term. For sure, we can have some knee-jerk reaction, but in the end, it doesn't matter.
Nothing matters here.
Yeah, it doesn't. It wouldn't impact the markets. It's only a small part of the grand scheme of things. North Korea is often put into the context of part of the exchange with China in this whole trade dispute. North Korea is probably a pawn, a symbolic one, in the middle of the U.S.-China tension.
Yeah.
Right? So it doesn't mean more than that. So unless we end up with some very surprise developments, when it comes to security, then yes, there will be bigger impact. But our base case is that it's not going to be a market impacting event.
Okay. Yeah, you just mentioned China, and I think I mentioned before that we also want to talk about the G7 summit coming up, because I think that's actually the more important thing. Yes, the other one is important for the world, hopefully, for no nuclear war, but for markets and in general, the G7 meeting seems very interesting, especially after Trump retaliating with his tariffs on Europe, and Canada, all his allies that he needs when he fights wars, the Americans, they're all, sentiment from those countries now. It's like, we can't even trust our partner anymore, right? So it's going to be very interesting to see now them all meeting in one place. Like, it will be very awkward, I assume.
Well, it's most likely going to be a repeat of last year where Trump is on the golf course alone. So the US is going to be very isolated in this G7 meeting. It already happened to the Treasury Secretary, Steve Mnuchin, in the G7 equivalent for the finance ministers. So the same thing is going to happen here. Likely that Trump may cut short the summit because it looks like North Korea summit is just a personally more important matter for Trump. It may actually win him a peace prize, Nobel Peace Prize, if something happens there. So, but however, yes, you're right. G7 meeting is going to see a lot of angry allies of the US expressing the same anger again and again. They may not even sign the communique. At the end of the G7 summit every year, they will have a joint statement, and all the countries will sign off on it. In this case, the French and even the Canadians have threatened that they would not do it. They would not do a joint statement. They would not sign it, or they would rather do a G6 without the US. So again, it's symbolic. Doesn't lead to anything, but it does revive some tension for trades. And I just want to say that they have already threatened to retaliate. They have already expressed their anger in the news. The G7 summit doesn't change any of that. The market has already brushed all of these sentiments aside and achieved new highs.
Yeah, and I think with achieving new highs, I think we can finally say, I think even the numbers are correct as well, that we're kind of out of the correction territory now. We had the last couple of weeks, last week, this week, continually seeing markets move higher. Tech was leading last night. They were not, but like on average, right? Tech is being leading the pack there. So maybe you can explain to the people listening what kind of your thoughts are on that and why that is happening. Kind of the next month or so looking like for us.
Well, firstly, it's good to know that at the end of January, we had a stock market correction of around nearly 12%. It was not triggered by the trade disputes. That happens as part of the natural cycles with markets. The trade dispute came in later, and what it did was to interfere with the speed of the recovery. And on average, it takes about 4 to 6 months to recover. And even with the trade interference, we have technically just gotten out of the correction. The NASDAQ has made new highs. So for the NASDAQ tech stocks, the correction is over. For the S&P, it hasn't went back to these original highs. So technically, the correction is still being partially corrected. So there's still some confusion when it comes to comparing the two indices. But what I want to say is that the market has been able to brush aside this trade tension. You have been realizing by now Trump's bite on the market is diminishing, because the last week or two we had it worse. The rhetorics, the news is just much more negative than before. Even a little of that in the past used to spook the market so bad, but this time the market just brushed it aside. And the main reason is fundamentals. As we always said, the ultimate driver returns are economic fundamentals.
Yeah.
And there's a few key developments that we can go into.
Yeah, please do. You did say the Fed minutes were one of the big highlights, right?
Yes, the Fed minutes was a game changer because it confirms that the Fed is not overly concerned about inflation overheating. The economy is doing fine. So what happened is what's already priced in terms of interest rate hikes is fine. It's not going to be more. That assuages the concern in the market. That's a really, really big deal. And the other game changer is the payroll numbers. I think at the end of May, the payroll numbers came out. It confirms that employment continues to improve, but with very moderate wage gains. Again, that assuages the fear on inflation. In return, assuages the fear on the Fed hiking more. And again, the growth story is intact. So what it means is this is as good as you can get in fundamentals. And the markets, having seen that on the last payroll number on Friday, last Friday, I think,
that's right.
That was a confirmation the market needed. Even though the rhetorics on trade was worse than before, we made new highs. That says a lot about what really drives returns beyond the short term.
Yeah. Is there anything maybe you can update for clients of StashAway or also people looking to sign up perhaps and listening today, kind of the forecast. So you feel like we're still in the same economic cycle that we've been in so far? No changes, any type in the next few, from the indicators you're reading, right? Kind of
I mean, my personal opinions aside, but just looking at the numbers, which is what we do at StashAway, yes, the numbers are solid. Growth adjusted for inflation is still improving. However, having said that, there are risks in terms of trade tensions, and emerging markets have a lot of hot pressure points. We have Turkey raising interest rates just to fight the currency moves.
16% now, right?
17 actually. So there will be some stresses here and there that will always come out. But the thing is, as long as you have a diversified portfolio, this thing shall pass. And in particular, to be more useful to you in this question, our framework has picked up that, yes, developed economies would do better from here than emerging markets, maybe in the next quarter or two, because of all these trade tensions and all these short-term emerging market events. So it's better to be actually invested in the US now. And if you really want to avoid trade tensions, small cap stocks in the US are very insulated from global forces like that. So they are places where the US now is starting to look really attractive, which is why the dollar went up and US markets are doing the best again. So,
but again, this could change, like you just said, right? And I think when you say, emerging markets might be not as good. If you have a diversified portfolio, you might get, you can buy it cheaper on the emerging market side, over time. With some dollar cost averaging. That's what we've been preaching before, of course, right? With the dollar cost averaging, would have really gotten, even through this correction, some really good price gains now, right?
Yes,
if you
absolutely.
just monthly done it in February, March, when the markets were on the down.
So the two main things is that diversification and dollar cost averaging. When you have a diversified portfolio, it's not all about emerging markets. You have Europe, you have Japan, you have US, you have different asset types that balances risk. That's always number one fundamental that you should remember. But number two is kind of when markets are down, it's not necessarily bad news because it's a savings-led investment plan. We contribute monthly. We make full use of it to build portfolio cheaper than before. So it's not all bad. It's actually an opportunity.
Yeah, and we actually have a question here from Adrian. Thanks, Adrian, for raising the question. He's asking, where do you see US dollar Sing going in, say, 2 to 3 years from now?
I would like to start, thank you for the question. I would like to say that nobody ever can predict where the currency market can go. But what I can say to you is dollar Sing tends to go up in bad times, which is why StashAway has always imbued a certain amount of exposure to offset the extreme risk when global market has a systemic meltdown. Just to pin some number down, in 2008 during the Lehman shock and the financial crisis, dollar Sing went up about 13.5% during the market rout. Dollar Malaysia go up as much as 44%. So versus the emerging market, the dollar effect is even stronger. So it's
a flight to safety, right?
The flight to safety thing. So if you are worried about a certain thing in September, August, some sort of near-term pressure points in the market, right? Having some exposure to dollar, to yen, to Swiss franc balances out a lot of risk in the portfolio. So I can't see where dollar Sing is going to go in the next 2 to 3 years because I have not seen anyone who can predict it that far. So I couldn't answer the question.
I think you did a good job of explaining that, but that's the truth, right? And especially with currencies, they move up and down, but they always have that average, right? Over time, they always go back to their mean, right? So it's just,
and I can only say that beyond the risk angle, we're very fortunate to be in Singapore, where it's managed against the dollar in a very tight band, as opposed to, say, someone in Malaysia, Indonesia, they have bigger swings in currencies. So we're very fortunate to be here. It's a very controlled currency regime. But we can still use it to offset risk in the portfolio, and that's what StashAway is doing.
All right, well, thank you so much, Freddy, and thanks everyone for joining in today again. If you listen to this video as a recording over the weekend or sometime next week even, and you have any more questions, feel free to either email us at support@stashaway.com or just write it in the comment section, a question, and we'll be sure to get to them. Everyone else, I think, have a great weekend and be safe next week for the Trump Summit. Bye.
Bye.